My name is Cade Bekanich, certified financial planner and owner of Park Lane Financial Group, and this is how single-income families can maximize retirement and education savings without getting left behind. Most financial advice ignores the reality of single-income families with stay-at-home parents, and some single individuals providing for an entire family. You work hard providing for your family while your spouse handles the even harder job of raising your children. But when it comes to retirement planning, conventional financial wisdom acts like both of you are earning incomes and building separate retirement accounts. But the reality is that might not be the truth. This disconnect can leave single-income households at a serious disadvantage when retirement finally arrives. This forces you to stretch one person's retirement savings across two people's retirements. In this video, I'm going to reveal the specific strategies that single-income families need to implement today to secure their financial future, including one of the most powerful IRA options that most advisors never even mention to couples. After working with dozens of families, many of them being single-income families over the past few years, I've seen firsthand how the right approach can completely transform their retirement outlook, while the wrong one can completely destroy your retirement plan. So let's get into it. The first strategy that single-income families need to understand is the Spousal IRA. This is arguably one of the most underutilized retirement planning tools for families with a stay-at-home parent. Most people don't even know it exists because financial institutions rarely promote them. So let me explain. A Spousal IRA allows the working spouse to contribute to an IRA or an individual retirement account for the non-working spouse, even though the non-working spouse doesn't officially have earned income. This is a critical exemption to the normal IRA rules requiring earned income to contribute to an IRA. In 2025, you can contribute up to $7,000 to a Spousal IRA or $8,000 if your spouse is 50 years of age or older. This is on top of your IRA or 401k contributions. Let me explain why this matters so much. With a Spousal IRA, you're essentially leaving thousands of dollars of tax advantages on the table every single year. Over decades, this adds up to potentially hundreds of thousands of dollars in lost retirement savings. Big difference. I have a client who we'll call Michael. Michael has been the sole breadwinner for over 15 years while his wife, we'll call her Sarah, has been raising their family. When they came to me just a few months ago, they had only ever saved in Michael's 401k. After implementing a Spousal IRA strategy, they were able to contribute an additional $7,000 annually to Sarah's retirement, which over the next 20 years, we anticipate potentially adding several hundreds of thousands of dollars to their retirement nest egg. Of course, we're considering the future contributions that they'll continue to make to that account. The second strategy you need to understand is dual expense retirement planning. This approach acknowledges the reality that you'll need to fund two people's retirement with primarily one person's income. This is a bit different fundamentally from a dual income household. Most retirement calculators and conventional wisdom suggest saving 10 to 15% of your income for retirement. But for single income households, this simply isn't enough. You need to be aiming for 20 to even 25% of the working spouse's income. Why? Because you're not just funding your own retirement, you're funding two retirement accounts. And although some of those expenses might be taken on jointly, at the end of the day, you are two individuals who require individual needs. Let me walk you through an example. If a dual income household earns $200,000 combined and saves 15%, that's $30,000 per year toward retirement. A single income household earning $100,000 or half of the initial amount, saving the same 15%, is only putting away $15,000, but still needs to fund two separate retirement accounts. This underfunding creates what's called the single income retirement gap, and that is why so many single income households find themselves financially stressed during retirement. Fortunately, hopefully you're hearing this video before you step into retirement. The third critical strategy involves tax diversification across several accounts. Single income families need to be especially strategic about creating tax diversity in their retirement savings. This means that having a mix of pre-tax accounts like traditional IRAs and 401ks, as well as Roth accounts and taxable investment accounts, all need to play a role together. Why is this important? Because it gives you the flexibility to minimize tax burden during retirement. For example, pre-tax accounts like 401k withdrawals are taxed as ordinary income. Qualified Roth withdrawals are completely tax-free, and taxable account withdrawals are only taxed on the gains, potentially at what's called a lower capital gains rate, depending on how long you've held the asset in the account. This flexibility is especially valuable for single-income families who don't have the luxury of two separate retirement account structures. And of course, this isn't financial advice, but it is something that I implement with my clients. I recommend a three-bucket approach. Try to allocate roughly 1/3 of your retirement savings to each type of account: traditional pre-tax like IRAs or 401ks, Roth IRAs, and taxable investment accounts. This gives you maximum flexibility when it's time to start withdrawing these funds, which ultimately helps you to keep your tax burden as low as possible. Which brings us to our fourth strategy, focusing on education savings by leveraging tax advantage education accounts. 529 plans are powerful tools for single income families because they offer tax-free growth specifically for education expenses. But there's a specific way to optimize them that most families miss. Many families make the mistake of only putting money into their children's 529s and neglecting their own retirement. Remember this, your children could take out loans for college, but you can't get a loan to fund your retirement. I hope that one sticks with you. The optimal approach is to first maximize your retirement savings, including that spousal IRA, then allocate additional savings to 529 plans. Here's why. 529 plans owned by parents have minimal impact on financial aid eligibility. Only about 5.64% of the value of these accounts go towards financial aid. And yet 529 still offer tremendous tax advantages. And earnings on 529 plans grow completely tax-free, while withdrawals for qualified education expenses are also completely tax-free, which means that the amount that was put into your 529 plan, grown through investment performance, and eventually used to fund your children's education will grow and be maximized just based on the IRS's qualifications. For example, in New York, couples can deduct up to $10,000 annually from their state income taxes for 529 contributions. And there's a little-known strategy that can supercharge your 529, and that's called front-loading. The IRS actually allows you to make up to 5 years worth of contributions at once without triggering gift taxes. What are gift taxes? You'll have to click on the channel to watch more videos. But back to this content. That means that a married couple could potentially contribute up to $170,000 in a single year to contribute to one child's 529 plan. Think about the possible investment growth over time if you're able to afford that early on during your child's savings plan. And the fifth strategy involves maximizing Social Security benefits for stay-at-home parents. Many people don't realize that a non-working spouse is actually eligible for up to 50% of the working spouse's Social Security benefit. This is a critical safety net for families with stay-at-home parents. However, there are specific claiming strategies that can optimize your collective benefits. For instance, it often makes sense for the higher earning spouse to delay claiming until age 70, which is the maximum Social Security benefit, while the non-working spouse chooses to claim their benefits earlier. Why does this matter? Because making the wrong Social Security claiming decision can cost a couple tens or even hundreds of thousands of dollars in lost benefits during their retirement. The working spouse should maintain careful records of their earnings history, since the non-working spouse's benefit will be based on this record. Any errors or missed earnings can directly impact both spouses' benefits. The final strategy is creating multiple income streams beyond traditional retirement accounts. Single income families are especially vulnerable to job loss or disability of the primary earner. Creating additional income streams provides critical financial protection. Consider investments like rental properties, dividend-paying stocks, or even a small business that the stay-at-home parent could potentially manage part-time. But raising a family is hard, so don't put too much stress on yourself. One of my clients, let's call her Jennifer, was a stay-at-home mom who started an online business during her children's school hours and currently runs that business today. And we anticipate that by the time her husband retires, her business will generate approximately $30,000 annually, which is in addition to her husband's income. And of course, this substantially reduces the pressure on their retirement accounts. This means that when her husband steps away from work in approximately 6 months, according to our financial plan, she'll be able to continually build her business, assuming that she enjoys it, and develop a consistent income stream during her retirement to supplement their current retirement plan. This diversification of income sources doesn't just protect you financially, it can also provide the stay-at-home parent with additional options for personal fulfillment and contribution. At the end of the day, everyone wants to contribute to their overall financial well-being, and this is a great way to start. So that's how single income families can maximize their retirement and education savings. So if you follow these strategies and develop a strong relationship with a certified financial planner, you'll likely put yourself far ahead of other single income households. It's my job to help you achieve a comfortable retirement, and this could be a great way to start. Doing this alone is much easier said than done, and you might run into things like feeling overwhelmed by complex financial decisions, struggling to balance short-term family needs against long-term retirement security, and worrying that you're missing key strategies or making costly mistakes that could derail your retirement. And with everything I've given you, you really have two options. Doing it all yourself, knowing the problems that you'll face, and I do wish you the best of luck. Or number two, partner with a certified financial planner from Park Lane Financial Group to help build you a comprehensive financial plan tailored specifically to your single income family's needs. And if you've picked the second option, then click the link in the description below to schedule your first meeting today. Together, we'll have a family wealth building session and work together to build a retirement that you deserve. Thanks for watching.